Imagine a product so powerful that it generates profit without producing anything tangible. A product so invisible that most people don't even realize they are buying it every single day of their lives. That product is debt, and far from being a neutral financial instrument, debt has been deliberately crafted into the most profitable product in human history. It has funded wars, toppled empires, enslaved nations, and quietly drained the wealth of ordinary people. And yet, ask most people where debt came from, who designed it, and why it dominates our financial system, and they couldn't tell you. The story of debt is not just an economic history. It is the story of money and power itself. Debt in its simplest form is a promise. You borrow today and agree to pay tomorrow. But in that promise hides the core of financial control. Interest. Charging interest turns the future into profit. For thousands of years, societies struggled with this idea. Ancient Mesopotamians recorded debts on clay tablets, but they also periodically wiped them clean in debt. Jubilees because leaders knew that when too many citizens were trapped in obligations, the system collapsed. In the Hebrew Bible, debt forgiveness is commanded every 50 years. The idea was simple. Debt was dangerous. It could enslave entire populations, if unchecked. But fast forward through centuries of history, and you'll see how elites learned not to erase debt, but to weaponize it. In medieval Europe, the Catholic Church officially banned the charging of excessive interest, yet merchants and bankers found ways around it. They disguised loans as trade contracts or created complex credit instruments that looked like anything but a loan. By the Renaissance, powerful banking families like the Medici and Florence built empires not on land or armies, but on lending. They financed kings, popes, and merchants, and in return received not only money, but political leverage. Debt was becoming more than a financial product. It was the engine of power. The real transformation came in the 17th century with the rise of state debt. When the Dutch Republic fought for independence from Spain, it raised money by selling bonds to its own citizens. Investors could buy government debt, receive interest payments, and trade those bonds like property. Suddenly, war was no longer limited by the gold or silver in a king's treasury. They could be financed indefinitely by selling the future. The Dutch perfected this model, and soon, England competed. The creation of the Bank of England in 1694 formalized national debt as a permanent institution. Instead of borrowing from individual lenders, the state borrowed from a central bank that issued notes backed by those loans. For the first time, a government didn't just raise debt in emergencies. It lived on, it rolling it over endlessly. And the bankers who managed this debt became indispensable to the crown. Debt had graduated from private contracts to the very foundation of state power. The profits were enormous. Lending to governments was the safest bet in the financial world, because governments could raise taxes to pay their creditors. Wars that once would have bankrupted kings could now be financed indefinitely. And those wars, in turn, expanded empires, opened new markets, and created more opportunities for debt. It was a perfect loop. The more nations fought, the more they borrowed. The more they borrowed, the richer their creditors became. By the 18th and 19th centuries, the bond markets in London, Paris, and Amsterdam were the beating heart of global finance. Armies, marched ships sailed, colonies were conquered, all on borrowed money. But this wasn't just about nations. As industrial capitalism spread, ordinary people were drawn into the cycle. Railroads, factories, and infrastructure projects were built on credit, financed through bonds and bank loans. Workers earned wages from companies funded by debt, and then they themselves borrowed to buy homes, tools, and eventually consumer goods. Debt seeped into every layer of economic life. By the 20th century, debt wasn't just a tool of governments or tycoons. It had become the everyday product sold to the masses. Mortgages, car loans, credit cards, student debt. The entire architecture of modern life was constructed to normalize borrowing as the default condition of existence. And here's the hidden genius, or the hidden cruelty of it all. Debt doesn't just create profit once. Every interest payment is a transfer of wealth from the debtor to the creditor, from the many to the few, repeated month after month, year after year. Unlike a product you buy once and use, debt is designed to be permanent, to lock you into a cycle of payments that never truly ends. A house bought with a 30-year mortgage will cost 2 or 3 times its sticker price. A credit card bill rolled over month can grow faster than your ability to pay it. What began as a promise becomes a trap. Debt, then, is not just a financial arrangement. It is the most successful business model in history. It requires no factory, no inventory, no raw materials. It generates wealth out of time itself. And the ones who understood this earliest, the merchants of Amsterdam, the bankers of London, the financiers of Wall Street, became the architects of the modern financial system. This system doesn't just manage debt, it manufactures it, expands it, and depends on it to survive. By the middle of the 20th century, debt had stopped being a tool used only in emergencies and had become the lifeblood of the global financial system. The Bretton Woods Agreements of 1944, celebrated as a new era of international cooperation, institutionalized this reality. The International Monetary Fund and the World Bank were founded to lend money to nations in crisis or development. But behind the lofty rhetoric was a simple mechanism: debt as discipline. Countries could borrow, but only on terms dictated by their creditors. The IMF, dominated by the United States and Europe, began attaching structural adjustment conditions to its loans. Entire national economies were told what to cut, what to privatize, and how to reorder their budgets. Debt wasn't just profitable. It became a lever of political control. Nations that borrowed too much found their sovereignty compromised. Their policies rewritten not in their own capitals, but in Washington or Basel. The rhetoric was about stability and growth. The reality was dependency. At the same time, a quieter revolution was happening in the daily lives of ordinary citizens. In the decades after the Second World War, banks discovered a way to sell debt, not just to governments and corporations, but directly to households. The mortgage became the crown jewel of middle-class aspiration. Owning a home once reserved for elites was suddenly possible for millions, but only by signing a contract that chained families to 30 years of payments. Car loans, furniture installment plans, and eventually the credit card transformed debt into a consumer product marketed like any other. The psychological shift was massive. Debt was no longer shameful or rare. It became the normal way to participate in prosperity. Buy now, pay later. Enjoy life today and let the future take care of itself. For banks, this was a gold mine. Interest from millions of households produced steady compounding profits. For governments, it created the illusion of endless growth, as consumer demand could be fueled by credit even when wages stagnated. For corporations, it guaranteed a steady stream of customers who could be enticed into spending money they did not yet have. Debt became the hidden engine of modern capitalism. And unlike selling physical goods, selling credit was infinitely scalable. You didn't need to dig a mine or build a factory. You just needed signatures, contracts, and the authority to create money out of promises. The danger, of course, was that the entire system became addicted to expansion. Banks didn't want debts to be repaid quickly. They wanted them to be rolled over, refinanced, extended. The longer people stayed indebted, the more profitable they became. Governments, too, learned that borrowing was easier than raising taxes. Politicians could promise benefits today and push the cost onto future generations. And central banks, with their power to create money, made it all possible by ensuring there was always enough liquidity to keep the wheels spinning. Debt was no longer a temporary bridge. It was the permanent architecture of the financial system. By the 1970s and 1980s, the consequences of this addiction were impossible to ignore. Developing countries across Latin America, Africa, and Asia had borrowed heavily in the boom years. Encouraged by Western banks eager to recycle petrodollars after the oil shocks, when interest rates rose sharply under Federal Reserve Chairman Paul, these nations suddenly found themselves unable to service their loans. The debt crisis exploded in 1982 when Mexico announced it could not pay.